Hey everybody, it's your boy Sean McLaughlin at Options Sean on Twitter. This is the All-Star Options Jam session for Thursday, April 18th, 2024. Hope you're doing well. All right, guys, we're doing something a little new this week, testing out some new stuff. Not sure if we'll stick with it, um, but we're testing things out here. So bear with me. I might screw something up. Gene, my tech behind the scenes, might mess something up. Who knows? We're flying by the seat of our pants, but I promise you it'll be well worth it. So here, for those of you who are new here, what we do here in the All-Star Options Jam session is we review open positions that we have on in All-Star Options, positions we have on that we've had on. Some of them we've had on for months, some of them we've had on for weeks, some of them we've had on for days. We review any position that either had an adjustment in the past week, or we exited over the past week, had a profit or a loss, that kind of stuff. And then we'll also run through some positions that we have open that we need to update stops on. And, this is also meant to be educational, right? You're kind of seeing how I go through my process here at All Star Charts, and I'm hoping that you learned something along the way. So before we get into the charts, I don't have the slide like I normally have. Hopefully we'll have that next week, but I have to drop the old disclaimer that everything we do here is for educational purposes only. I'm showing you what I'm doing with my money, and I hope that you learn something along the way. So I'm going to try to monitor the chat. If you guys have questions, go ahead and throw them in the chat. I'll try to answer them if I can. But we have a lot to get through today. It's been a busy week. As many of you know, a lot of positions got stopped out this week. Good news, bad news on that. Obviously, some of them were losers. Many of them were losers, small losers. But we also harvested some profits and some big wins. So it's a mixed bag, but busy bag. So let's start with the high level chart here. I got the S&P 500, and by the way, hot new charts. Here's one of the new things we're going to try this week. My friends at TrendSpider hooked me up with their charting platform. I'm going to try to go through showing you guys charts with real-time data. Yeah, just try to be a little bit more consistent here. So we'll see how it goes. Let me know if you think this is a good move. Anyway, we're looking at the SPY right here, S&P 500. Very clearly, we've rolled over the last couple of weeks. The monster trend off of the late October lows has appeared to exhaust itself. We are below the 50-day moving average, which I'm not saying that's a red alert by any means, but it's notable. It's the first time we've been below the 50-day moving average since November 1st, right? So that's notable. Now, does that mean the market's going to crash from here? I don't think so. That's not the bet I'm willing to make, but there could be a little bit further downside. Certainly, there could be some sideways, choppy action over the next several weeks. So that's something to be mindful of. Of course, VIX, we'd like to talk about VIX. We had a good spike in VIX late last week into the beginning of this week. We're coming back a little bit, but still VIX at more elevated levels that we've been in the last 5 months. Will we break the peak that we had back in October? It's possible, and if so, things could get really interesting. But for now, VIX is telling us definitely that this is a more challenging market than we've been used to over the last few months. All right. Now, the first trade I want to talk about is a trade that we made an adjustment in. This is FXI. This is a longer term trade that we've put on, that we had a plan to buy into this in tranches, meaning we bought a third of our position at a time. We finally got our third fill the other day right in here. Basically, what we did is we're buying the January 26 calls. When we first got into this trade back on February 28th, I believe it was, or February 27th, we paid $2 for those calls. A few days later, we got the next tranche at $1.75 cheaper. And then during this pullback that we've had here, we got our third tranche, which was, again, all part of our plan. We got the third and final piece at $1.50. So now we're all in on this China FXI play. This was a bet on a bit of a turnaround in China large cap stocks. And because we have until January, we have a lot of time for this to play out. This is why we kind of took our time building the position. But now we're all in. But our stop now is at right around 23 here. As long as we stay above this purple area here, we like this trade. All right. Now, I debated whether I should start with the good news or the bad news. Let's start with the bad news, right? Who starts with the bad news? Nobody does. I'm going to start with the bad news. Let's just rip through all the trades that we got stopped out of this past week. There were a number of them. We got stopped out of something like 9 trades. So in no particular order, let's start at the top here. Let's start with fast. We got into this trade. I mean, look at this entry. Could you have timed a more beautiful entry? I mean, we literally bought the top in Fastenal back on was that May 21st, or sorry, March 21st. We bought August 85 calls. We paid $215 for them. We literally marked the top. Congratulations, well done. I couldn't even do that if I tried again. But we got stopped out, closed below our level, below our risk management level, and we closed there for 15 cents. Basically, not 100% loss, but pretty close to it. But as I always like to reiterate, guys, when we put these trades on, back when I put this trade on up here, I sized my position such that if I lost 100%, it's still just, no more than a 1 or 2% hit to my portfolio. And that's the case here. So yeah, we lost most of it, but it's not going to change my life. But we're out of Fastenal. All right. Next up, SLG. This was our bullish bet on Manhattan real estate. We got into this trade here back around early mid-March. We bought a July 50-70 bull call spread. So that means we were long the July 50 calls and short the July 70 calls. We paid $565 for it. It was starting to go our way. It was looking pretty good, but the market had other ideas. It came down, stopped below our updated stop loss level. So we closed the spread for 407. Not that bad of a loss at all, right? We paid $565 for it, got out for 407. Those are the kind of losses I'll take all day long. No big deal. But we're out of SLG. Okay, next up, Wells Fargo. This one's a little tricky because we have 2 trades going on here. But we talked about this last week. We right in here on April 5th, I believe was the day. We were making a short-term bet, which was an add-on bet to the long January 60 calls we got into back in January. These had a year to expire when we got into them, but we did an add-on trade right in here. We were making the bet that coming out of earnings, Wells Fargo was going to have a pop. Well, guess what? Wells Fargo is today, as of today, having that pop. Much delayed, unfortunately, 3 days too late, because we were betting that pop would happen coming right out of earnings. The market had other ideas. We closed our calls at basically a 50% loss, which was the plan going in. When I wrote the blog post, I said, look, if these calls lose 50% of their value, or we had a stop loss level as well, but the stop loss level, or if they lost 50% of their value, we would close the trade. And that's what happened. I got out of these calls 2 days ago, right? Yeah, 2 days ago for 52 cents. Am I kicking myself right now? Yes and no. Yes, because look, what we expected was going to happen is now happening, but it didn't happen according to the plan that we laid out. And I'm a slave to my plan. Risk management is job number 1. And so we are out of Wells Fargo, sitting on the sidelines with that small tactical bet, but we're still long the January 60 calls that we paid $1.75 for. And by the way, this is an updated stop right here for this January position. We moved our stop to 55.25. As long as Wells Fargo stays above that level, at least for the foreseeable future, that we'll keep riding those January 60 calls, which are rolling pretty well for us right now. All right, next up, ARK. This is the ARK Innovation ETF. This was a trade we put a strangle on right in here back around April 4th or April 3rd. We put on a May 44.53 strangle, meaning we were short the 44 puts and the 53 calls. We collected $1.80 for it. Well, you can see these horizontal lines here. These were our stop loss levels. And as you can clearly see here, we violated our stop loss level early this week. So we had to close the trade. But the good news is we got out for 203. So we collected $1.80 going into the trade. We got out for 203. Not a bad loss at all, right? 23 cents on a trade that clearly did not work for us and did not work for us in a hurry. Again, small losses. That's the name of the game when we're doing here. The small losses, we could take small losses all day long because we're trading in such a way that when we get some wins, we can get some big wins, and we'll see some of those in a little bit here. All right, next up, XBI. This was also a short strangle that we got into, looks like May 27th-ish. We sold a May 85 105 strangle for $2. And you can see our stop loss levels here, these horizontal lines, and very clearly we closed below it just a few days ago, and we had to close the spread for 326. We collected $2 on the way in. It cost us 326 on the way out. A little bit more of a loss than that ARK trade, but again, completely manageable. We can survive those types of losses. And by the way, guys, we've talked about this in past jam sessions, but I will reiterate, when position sizing naked options, right? When we have a strangle on, which is a naked call and a naked put, you want to be conservative with your position sizing. I have two ways that I like to size these positions. I have a quick and dirty way. It's a little bit more aggressive. And then I have a much more conservative way. I typically do the more aggressive sizing with ETFs, this included. What I like to do is I like to collect on day one when I sell the spread and collect, in this case, $2. I want the premium that I collect to be equal to about 1% of the value of my portfolio. So let's just keep the math simple. If I've got a $100,000 portfolio and I'm willing to risk 1%, or I want to collect 1%, that would be $1,000. And so in this case, I would sell a 5 lot of this strangle, right? Because 5 times $2 works out to be $1,000 in credit. Okay. So that's how I size these positions. And so when we take a loss like this, losses always suck, but they're completely manageable. They're not very big hits to the portfolio. All right. So we're done with XBI. Next up, CVNA, Carvana. This was a short squeeze bet. We were betting on a very fast short squeeze driven move. We got into and we did it on a short-term bet, right? So back on late March, we bought the May 125 calls. I don't usually buy calls with that short a time to expiration unless we have a very tactical reason to do it. And in this case, we were betting on a short squeeze materializing back when the stock market was more cooperating for these types of plays. We bought the May 125 calls for $4.50 debit. Well, the short squeeze that we were betting on never happened, and it came back and closed below our risk management level. I sold the position for 61 cents. Not 100% loss, but we lost most of it. That's okay. Again, position sizing is what keeps us in the game. Moving on. This is the last of the losses, by the way. And then it gets better. We have better news after this. All right, CDNS, Cadence Design Systems. Back in late January, we bought a May 330 call spread that we paid 1035 for. And it was looking great. We had some really good moves here. It was following the 50-day moving average higher. Gotta love it. But unfortunately, it got a little slippery. It lost its support over here around 303. And we had an updated stop on that, updated stop level on that, and it broke and we had to exit. But the good news is that we paid 1035 to get in. We closed it for 960. So not quite a scratch, but pretty close to a scratch. We didn't lose a whole lot of money on this trade. All things considered, no big deal. But we are out of CDNS. All right. We ripped the Band-Aid off. That's all the bad news. That's all the losing trades. All right, great. Now let's talk about some winners that more than paid for all these losing trades. All right, let's talk about ECL, Ecolab. We got into this trade here in late December. We bought the July 220 calls for $5 right in here. We had a big earnings surprise here, big earnings gap that really moved this thing in our direction. Things were going great, going great. It was looking like it had the potential to become one of our biggest winners of the year. But then it ran out of steam and it broke its 50-day moving average, and I closed this trade for 1015 credit. Hey, we more than doubled our money in this trade. Very nice. If we take these kinds of wins and more like the ones we'll see coming up, always more than pays for the losers. All those ugly losers we just were, that they weren't ugly, they were small losers, but pays for all those losers. That's how this game works. All right, next up, Amazon. Here's a good example. We bought back in November, late November, we bought a July 150, 180 call spread for $10.80. Bought it right in here. And I mean, other than a little bit of a scary move here at the beginning of the year, right after, January 1st, it's been nothing. It was nothing but smooth sailing, including a nice gap higher here in early February. And guess what, guys? We had a profit target because this was a bull call spread, right? So it had defined risk and it also had defined upside. The most that spread could be worth was $30 because of the difference between the strikes. We were long the 150, short the 180. The difference is $30. So the most that spread could be worth is 30. Well, as part of our plan that we laid out when we put the trade on is 189 was the level we were looking for. If we got to 189, that's when we were going to take profits and close the trade. And boy, I mean, I didn't know at the time that that was going to be very near the top. The top on that day was how high? It got as high as 189.77. So, boy, as soon as it crossed 189 on that day on April 11th, we closed the trade and we got 24.20 for it. 24.20. Yeah, say that 20 times fast. So we paid 1080, got out for 24.20, more than doubled our money. Following the plan, hit the profit target, and we are out. And I'm feeling pretty good about that right now, considering we've pulled back, although that's not a very vicious pullback at all. All right, more good news. Cloudflare. So this is a trade we got into back in late November. We bought this breakout. You can see right here, we bought the June 100 calls for $6. It was going pretty well. We had a little scary little pullback again, but a January 1st pullback that tied up a few of our stocks, but we survived it. No big deal. And then earnings. Wow. We had a fantastic earnings event in late or early February. And in this case, the plan that I had laid out for the trade going in was if we broke $100, which was right here, this level, if we broke 100, then I was going to take profits. I was going to at least take all my original risk capital out of the trade. Well, it blew way through 100. The stock opened at nearly 110 the day following earnings. So instead of selling half of my position, which is what I normally would do, and I kind of regret that I didn't in this case, I sold the out of the money June 120 calls. So I was long the June 100. I sold 120 calls, creating a vertical spread, but I only sold half. So for example, in fact, I could tell you exactly, I bought 2 June 100 calls, right? I sold 1 June 120 call for $13. So that $13 that I collected there, more than paid me back for my original investment. So, right. So I had 2 calls at $6 a contract. So that was $1,200 investment. Well, I got $1,300 back just by selling 1 out of the money call here. So locked in $100 guaranteed profit. And I really thought this thing would continue on higher. Unfortunately, it did not. It's just done nothing but fade. It hit our stop loss level this week. I closed the position, which at this point was 2 of the June 100 calls and 1 of the June 120 calls. All in, I got 943 for that. So it kind of works out. The math works out to be 521 per unit, right? Great trade. I paid $6 for it. Got out for 521 per contract, almost a double on my money. We'll take it. This trade, we had a lot more profit in this thing, and I wish we could have captured more. But hey, the only way you get the big wins is by sitting through the pullbacks and hoping that they keep going higher. But this one had other plans for us, unfortunately. All right, last up for the trades that we've exited here. This is TEL. Oh, this one's not good news. This is a losing trade. We got out of this one today. That's why this is last. This was a short one, man. We just got into this one last week. We bought the October 165 calls that we paid. Let's move this here. You can see it better. We paid $370 for it right in here. Well, it quickly hit our stop loss level. The good news is that we got out for $275. So not a terrible loss. When losses happen quick like that, that's usually good news. That means we're not going to lose a whole lot because there's still plenty of time left in these calls. We may come back and revisit this trade again when the market firms up. But for now, we're out. We paid $374. We got out for $275. No big deal. All right. Whew. That was a lot of action this week. Could have been more. We had a bunch of other stocks that intraday hit their stop loss levels, but bounced up and closed higher. And I'm all about the closing price. I wait for the closing price. If the closing price is below my risk management level, then I'll exit on the next trading day. We had a few others again that teased them this week, but they bounced back. Robinhood is one of them. One example, top of my mind. Okay, now next up, we have a bunch of positions we want to update stops on. Let me go to my new updated stops list. All these cool new features I'm playing with here in TrendSpider. By the way, shout out TrendSpider for letting me play around with this. I really appreciate it. We'll see if we can make some good stuff out of it. All right, so we already discussed Wells Fargo. We moved our stop from that original position in Wells Fargo, moved our stop up to 55.26. So we'll go over that quickly. AOS, the A.O. Smith Corporation. This is a trade we got into back in March 20th. It's not really working all that well for us right now, chopping around, but let's see. I like the way it's reacting today. I like the way it bounced off its 50-day moving average. We'll see if it can start moving higher again and making new highs. But right now, our updated stop is 85. Any close below 85 in AOS will get us out of that trade. Next up, Dash. Dash has been flirting with our stop loss level. In fact, Dash was one that intraday traded below our stop. It's back higher above it right now, which is great. But basically 130, this is not exact, but 130 is our new stop in Dash. As long as we could stay above 130, we'll stick with this trade for now. We're long the August 175 calls that we paid $4.54. All right, FCX. This is a call calendar spread that we're in. We got into this a few weeks ago, back around March 28th. We're short the May 55 calls and long the January 55 calls. We paid $3.65 for it. As long as FCX kind of mucks around in here, this trade is working for me. Because what I would like to do is I would like these May calls to get cheap, and then I'll roll them out to the next month for more credit. That's at the same strike. And I think we're getting close. But when the May options, when those May calls get below 25 cents approximately, that's when I'm going to roll them into June to bring in some additional credit, lower my risk in the trade. And as long as we're below 52 bucks, I don't have a line here, but as long as we're below 52, the plan going forward is I'll keep rolling those options. If we're above 52, then I'm not going to roll. I'm going to hopefully let them expire worthless, and then we'll have unlimited upside potential if it continues to go higher. But for now, for the whole position, our stop is now 46.50. If FCX comes back and breaks 46.50, I'm going to close the entire position, whether I have a calendar spread on or just the long calls. Either way, we'll get out of that trade. All right. SEC Limited. This is a risk reversal that we put on back in late Feb. We sold the 35 puts in June and used those proceeds to buy the 65 calls. We did it all in for a 50 cents net credit. Trade's been working great for us so far. Those puts are basically worthless. We could probably cover them for nothing if we wanted to right now. I haven't, but you could. But the trade, it was looking awesome. We want to take some profits if it gets up to 65, and it looked like we were going to get there. But now it's consolidating a little bit. I love the way it bounced off the 50-day moving average a couple days ago, which now is what we're using as our stop. As long as SEC Limited can stay above 52 bucks a share, we're going to hold on to this trade and hold out for that profit target up there at 65. And the last stop to update is VLO. There's some good news in this trade. We got into this trade here back in early March. We bought the September 175 calls for $4.50 debit. Got in right there. Boy, this thing basically took off right away for us, which is always a good sign. The biggest winners that I ever have tend to be trades that start working right away. Uber from earlier in the year is a good example of that. There's IBM is another good example of that from earlier in the year. And this one is following the same script. It just ripped higher, basically took no heat in this trade. And we had a plan listed out that if we broke 175, this horizontal level here, if we broke 175, I was going to take some profits off the table and at least get paid back my original risk capital. In this case, I only had to sell a third of my position, and I got $15.35 for it. All right, so I bought the 175 calls for $4.50. I only had to sell a third of them for $15.35. Now I've got locked in profits, not a lot, but can't lose now in the trade, which is great. Guaranteed profits. And our new stop now is at 157. It's kind of been a gut wrenching pullback, unfortunately, but at least we're riding this trade with the comfort of knowing that we can't lose. In fact, we're still winning, even if these calls go to zero, which they're not a zero right now. These are 175 calls that have until September. So whatever we end up exiting these calls for, that'll just be additional profit in the trade. But our current stop right now is 157 on VLO. Whew. Okay. We had a lot of positions we entered and exited this week. We had a bunch of stops we have to update. The last thing I'll just go through real quickly are the new trades that we've added this week. Let's go over here. I'm not going to get into the full details on these trades, by the way, guys. Every trade that we put on a detailed blog post that has the rationale for why we like the setup, what strategy we're going to use to best take advantage of that trade, where we manage risk, where we'll get out of the trade to minimize losses, and if and where we will take profits. So all those details are in the blog. If you go to allstarcharts.com, go to the members section, go to the options section, you will find all the detailed trading plans that you can review at any time. If you don't have access to that, please hit us up with an email, info@allstarcharts.com. We'll be glad to set you up so that you have access to it. But two trades, there's actually three trades, but one of them we already got stopped out, and that was the TEL. We already discussed that in and out since we last spoke last week. The next is Deere & Company. We got into this earlier this week. We're putting on a delta neutral bet here. We think this is in for some sideways action. And then the next trade we put on since we last spoke is Berkshire Hathaway. We put on a mildly bullish bet here in Berkshire Hathaway. I feel like, it's pulled back, but this thing had 11 out of 13 trading days were losers. That's quite a streak for Berkshire Hathaway from right here, from starting April 1st until yesterday. And 13 trading days. Out of those 13 trading days, 11 of them were red. I'm willing to take the other side of that bet. I think that Berkshire is due for a little bit of a bounce here. Maybe it doesn't go back to all-time highs. I don't need it to for this trade for us to make money. Again, all the details at allstarcharts.com. All right, everybody, you made it. That's it. Thanks for going through this experimental options jam session with me this week, trying out some new tools, some new things. Let me just check the chat here real quick. Do I have any questions that need to be addressed? Does not look like it. All right, very good. I don't have a potential downside target for Apple today. Apple is a trade that we have on. Let's pull it here real quick. I'm short an iron condor here, so I would rather Apple just stay in the middle and do nothing. We're short a iron condor here. We're short the 160 puts and the 180 calls and protected $10 away. You can see where our stops are. As long as Apple stays in this median in the middle of that range, that's all I wanted to do. So I don't have a downside target for you. All right. All right. That's all I got, guys. Thanks for the question. I think this went well. Maybe we'll try this again next week. Thanks for tuning in. Actually, no, programming alert. We're going to do this one day earlier next week. Programming alert for you as well, Gene, my guy behind the scenes here. I'm not going to be here next Thursday. Me and my family are going to the Redwoods National Park in Northern California to go spend a few days hiking in the redwood forests. So I won't be here Thursday. So we're going to do this on Wednesday, probably the same time, but not 100% sure on that. So we'll do it one day earlier next week. So there's your little programming note. Anyway, thanks for tuning in, guys. We'll see you again tomorrow. Take care.